Hello everyone, thanks for watching. I'm going to go over my newest quant finance project, which is actually more focused on options premium, distributions, and derivatives markets rather than fixed income or the cash to basis trades that I usually fixate on. So what is the purpose of this? The purpose is actually, in my previous video, and kind of where I'm heading with my research, I'm starting to believe that the future of fixed income relative value is going to be this sort of retail participated ETF to institutional markets, a sort of sell the macro rich, buy the macro cheap. And I'm trying to build models to help show the differences in premiums and distributions between ETFs and futures. So first of all, let's go through each section. For our inputs, we have the spots. So we put in the spot ETF price, the future spot price. We put in from futures to ETFs, the ratio. So this is kind of in a conversion factor, like how the CME to CTD ratio works. It's kind of in a similar fashion. Here's the converted futures price. But for this model, we're going to assume the remaining basis is only due to financing, yields, dividends, whatnot. Now, this is where I am going to admit the model is going to be inaccurate to some degree because, for instance, if you're doing a bond future to bond ETF trade, even with financing removed, there's still a duration mismatch, which is going to give a little bit of basis. But here, the index price is going to be the ETF price. So when we convert the futures, we're just going to convert it into the scale of the ETF. I understand that this could cause maybe a little bit, even with fees within the ETF's yield, it could cause a little issues. Here we put in the contract multiplier of the future, the contract ETF of the future, and then we get our hedge. Now this hedge isn't just contract multipliers. I'll show you with the ratio. If I change the ratio, the hedge value, the delta neutral hedge value is going to change. So basically, the simple formula is to convert the futures, it's futures times the hedge ratio. Index is basically, we return back to the ETF price. This is kind of redundant. And then the hedge delta value is the contract multiplier ratio multiplied by the notional value exposure ratio. And that's what gives us our delta neutral hedge. And we're expressing that in single options. This isn't really a project for credit spreads, iron condors, and other such strategies. This is just a single option premium modeling. Now we have our ETF chain. We put in, these are fixed. We're looking at out of the money. So we have our 1, 5, 7, then 10 through 45 in units of 5 for deltas. We put in the strike and the premium. So we're not looking at the mark of the option. We're looking at the total premium. So we put that in. We put it in for the futures. As you can see, the mark for this would be 1.8. The reason why it's 90 is I'm using the SPY to ES to model this just because it's liquid enough. The math looks decent. And this was the live data on Friday's close, Friday the 12th. So this isn't hypotheticals I'm actually using here. We put in this, and then we convert. So this is that 68.15, but in units with that index formula and the ratios. This is in units of the ETF price. So ultimately what we're going to look at here, and this is my main focus, the bottom graph, I'm going to need to get a bit better with my data on converting futures and doing some data hygienics. But this is the one that my project, I feel confident that it can model, is we're looking at premiums at delta levels. So as you can see, the polynomial line, even, not just the spots, as we get closer to in the money, there is a significant gap of premiums. And that, and this is the delta neutral premium. So this will be the premium if we bought SPY and we sold ES, or we did the inverse. That would get us to exact delta neutral. And you can see the premiums on the SPY ETF are above the premiums for the futures. So to some degree, the SPY premiums are richer than the futures. Now, this may not be as significant as to build like a high frequency strategy around. It could be, but ultimately, as I continue these projects, I would be really interested to look more at like ZB to TLT premium curves. Kind of the hypothesis I gave in my presentation video is that retail participation, it'll be so novel in the fixed income world, this might cause the distributions to change. And here I have the delta distribution priced on an ETF scale. So x-axis price, y-axis delta. And you can see here with the model, the ETF has further distribution, which aligns with it being a richer premium. So distributions are further out for the same deltas, and they're richer as well, while the futures are a cheaper market and distributions are closer in. So again, I'm not confident in this hedge ratio here. I just did the 0.1. That's just the standard desk convention, but I would need better math for that hedge ratio. But if we did trust that, the trade here, the relative value trade, would actually be to have two monitors basically going. You would provide liquidity. You would write the options on the SPY, and then you would buy the options on the ES or the futures. And this would be an ETF to futures options relative value trade. And even though the data here is an S&P, where I hope to go with this is to continue for fixed income relative value. And hopefully we can start modeling how the newer retail exposure and ETF options is going to work with the CME Treasury futures. Anyways, thanks for listening. This was more of a simple student project, but I'm hoping to dive more into the options market as well, not just financing basis. Have a great rest of y'all's day.